to, invest in markets through, let's say, crypto. They're investing in it, but now we could get them into the more traditional long-term retirement products. So we look at that as the next wave of opportunity for BlackRock over the next tens of years, as we start moving away from traditional financial assets by repotting them in a digital manner, and then having people stay in that digital ecosystem.
And I think hard assets have to enter the equation today. Gold, Bitcoin, things that give you a little bit of ballast in the portfolio against potential for currency depreciation.
What you just heard wasn't commentary. It was a roadmap. Larry Fink is telling you where the world's largest asset manager is allocating capital for the next several decades. And Rick Rieder, the man saying Bitcoin belongs alongside gold, may soon be setting U.S. monetary policy. Because right now, BlackRock's chief investment officer is the leading contender to become the next chair of the Federal Reserve. That is the story. If Rick Rieder is nominated, this would mark the first time in history that someone who openly views Bitcoin as a portfolio hedge and tokenization as the future of finance sits at the very top of the global monetary system. And that changes the trajectory of crypto in ways most investors are not yet pricing in. This week, financial markets were blindsided by an unexpected development. Rick Rieder, long considered a long-shot candidate, has surged to the top of the list to replace Jerome Powell as Federal Reserve Chair. As recently as last week, prediction markets gave Rieder just a 3% chance of landing the role. Then something changed. After President Trump publicly described him as very impressive, and White House economic advisor Kevin Hassett called him the best bond guy, Rieder's odds exploded, jumping above 40%, overtaking every other contender. Trump has now confirmed that a decision has been made and that the nomination will be announced soon. Markets are paying attention, and so is crypto, because Rick Rieder is not just another central banker. He is a part of a giant financial giant which is going all in on Bitcoin, digital assets, and tokenization.
I believe Bitcoin is legitimate. I'm not trying to say there's not misuses like everything else, but it is a legitimate financial instrument that allows you to have maybe uncorrelated, non-correlated type of returns. I believe it is an instrument that you invest in when you're more frightened, though. It is an instrument when you believe that countries are debasing their currency, debasing their currency by excess deficits, and some countries are. I believe we have countries where you're frightened of your everyday existence, and if you have an opportunity to invest in something that is outside your country's control, then you can have more financial control. And so I'm a major believer that there is a role for Bitcoin in portfolios.
Why a Rieder-led Fed is different. For crypto investors, this potential nomination matters for three critical reasons. First, for the first time in history, crypto-aligned thinkers are moving into the highest levels of U.S. economic power, a pro-crypto president, a pro-innovation SEC chair replacing Gary Gensler, and now, possibly, a Fed chair who understands Bitcoin not as a threat, but as a portfolio necessity. Second, Rick Rieder comes directly from BlackRock, a firm that has made it unmistakably clear that crypto is central to its long-term strategy. Larry Fink has openly stated that digital assets represent the next multi-decade opportunity for BlackRock, and if Rieder moves from BlackRock's CIO seat into the Federal Reserve, he brings with him a deep understanding of why tokenized markets, Bitcoin, and blockchain-based infrastructure are not fringe experiments, but inevitable upgrades. Third, and most important, Rieder's view of crypto goes far beyond price speculation. This isn't about number go up. It's about how capital works in a world of rising debt, currency debasement, and outdated financial infrastructure. To understand just how transformative this could be, it's worth revisiting something Rick Rieder said back in 2023, long before this Fed chair speculation existed.
I think people tend to talk about Bitcoin quite a bit, and as the one place as an investment tool. I mean, the market capitalization of crypto assets we think is about $2 trillion, and it's across more than 10,000 different assets. Bitcoin is still, we think it's about 45% of the market share, but boy, there's a whole series of different investments in and around. Maybe I'll talk a little bit about, what is and how do we think about crypto generally and digital assets, particularly as investment tools. One is store of value. How do they fit your portfolio as a store of value? I mean, for years, gold was arguably the exclusive domain of store of value. And, that wasn't an interest rate product, et cetera. And so, like gold, Bitcoin has a fixed supply generally, and it's given certainly the rise to this idea that Bitcoin and or Ethereum and others are functionally digital gold. So the store of value is within your portfolio, and as an uncorrelated asset relative to that, it's clearly taken on some of that. The idea of protocols, blockchain applications run on underlying protocols is something that is going to be something, we think is going to be significant and will continue to be significant. And, quite frankly, one of the areas around these protocols are things like tokens, application tokens. Some of these decentralized applications have a token attached with them, which powers the application, et cetera. So it's an incredibly interesting part of how finance is going to grow when we think about things that are tokenized going forward. So it's something that is fascinating, and I think it's an evolution of investing that goes well beyond. Do you think Bitcoin's price is going up or down? And obviously, stable coins as well are something that are really interesting in terms of transferability, traceability, global functionality. So this concept of tokenization of cash and a transmission of financial assets in a more efficient manner is, one of the most fascinating developments I've seen in markets in a very long time.
In that interview, Rieder laid out a framework that most investors still haven't fully grasped. He explained that crypto is not one asset, it's an entire ecosystem. Bitcoin as a store of value with fixed supply, analogous to gold. Ethereum and other networks as digital infrastructure, powering applications, settlement, and financial logic. Tokens as economic engines for decentralized systems. Stablecoins as programmable money with global reach. And most importantly, he emphasized tokenization, the conversion of traditional financial assets into blockchain-based instruments, as one of the most important developments markets have seen in decades. Not hype, not speculation. An evolution of investing itself. Why Ethereum stands to benefit most. If BlackRock, and potentially the Federal Reserve, are serious about tokenization, then the question becomes, where does that system actually live? At Davos, Larry Fink made his position clear. He argued that the financial system needs one common blockchain, a shared settlement layer that reduces fees, corruption, and friction.
I think the movement towards tokenization, decimalization is necessary. It's ironic that we see two emerging countries leading the world in in the tokenization and digitization of their currency. That's Brazil and India. I think we need to move very rapidly to doing that. We would be reducing fees. We would do more democratization by reducing more fees if we had all investments on a tokenized platform that you could move from a tokenized money market fund to equities and bonds and back and forth. We have one common blockchain. We can reduce corruption. So I would argue that yes, we have more dependencies on maybe one blockchain, which we could all talk about. But that being said, the activities are probably processed and more secure than ever.
While he didn't name a specific network, much of the crypto community believes the most likely candidate is Ethereum, not because it's speculative, but because it already dominates institutional tokenization, stablecoin issuance, and real-world asset experimentation. Ethereum isn't trying to replace money. It's trying to replace financial plumbing. Tokenization is no longer theory. This isn't abstract anymore. Tokenized assets already exceed $22 billion, with U.S. Treasuries leading the way. The New York Stock Exchange has now announced plans to launch a tokenized securities platform, featuring stablecoin settlement and 24/7 trading. Major banks like UBS are openly stating that blockchain is the future of traditional finance. And industry forecasts now project tokenized assets reaching tens of trillions of dollars over the next decade. This is no longer crypto trying to enter Wall Street. This is Wall Street rebuilding itself on crypto rails. This brings us to Jordi Visser's insight from Real Vision. Visser draws a powerful analogy. Bitcoin is like gold. Ethereum is like silver. Gold moves first. Silver lags. Then utility kicks in, and silver accelerates faster. According to Visser, we're approaching that exact inflection point in crypto. Bitcoin establishes legitimacy. Institutions pile in. Then, utility-driven networks, especially Ethereum, begin to outperform as real economic activity expands on-chain, not because of speculation, but because they are being used.
When I get into the charts of Bitcoin, I've been showing lately utility over Bitcoin. So think of Ethereum over Bitcoin as very similar to silver over gold. Gold was leading, silver was lagging, and then the utility function kicked in. And everything kicked in really during the summertime. If you do an overlay of Micron Technology stock relative to silver, you'll see a very similar pattern. Now, here's the way I want to kind of break it down for you guys, because Jensen Huang says this, but so you get this whole like process of going from energy, so think of it as anything you want, gas, oil, but the physical fossil fuel side, it needs eventually to be converted into intelligence. With inside that conversion are two tracks. One shortage is in high bandwidth memory. That is the chips that are necessary. So the reason Micron, SanDisk, Western Digital, SK Hynix, Samsung have all gone banana zone is because there's a scarcity right now relative to the demand. There's a race to buy this in massive size. On the other side, you have the conversion in the efficiency side for energy. And that's where transformers fit in, gas turbines fit in, silver fits in. Silver fits in on both components. You're just at a point where all of the utility side, those charts are going higher. And so eventually you will get to the point, and this is why Ethereum to me will be the one to watch for the breakout, and then Bitcoin will go with it, because we're now at a point where people are talking about silver. They're not talking about gold as much. And the reason is because silver is going up at 2 times the pace of gold. And I think you'll start to see that in crypto the same way.
So when you connect all of these dots, BlackRock's strategy, Rick Rieder's philosophy, tokenization going mainstream, and Ethereum's role as financial infrastructure, a clear picture emerges. Crypto is no longer fighting for inclusion. It is being installed at the core of the system. And if Rick Rieder becomes the next Fed chair, that shift may accelerate faster than anyone expects. Meanwhile, while institutions are quietly rebuilding the financial system on blockchain rails, the macro and geopolitical backdrop is doing the exact opposite. It's becoming more volatile, more fragmented, and far less predictable. And this matters, because crypto does not exist in a vacuum. Its biggest bull markets have always emerged not just from innovation, but from stress inside the traditional system, when trade, fiscal policy, and governance start breaking down at the edges. And right now, those pressures are resurfacing fast. Trade war risk reignites. President Trump says he will impose a 100% tariff on all Canadian goods and products if Canada makes a trade deal with China. Just 8 days ago, Canada announced a new strategic partnership with China. Using Truth Social, President Trump warned Canada that if it proceeds with deeper trade integration with China, the United States would respond with 100% tariffs on all Canadian imports. Trump has made it clear that he will not allow Canada, one of America's largest trading partners, to become a drop-off port for Chinese goods entering the U.S. market. In multiple statements, he framed the issue not just as economics, but as sovereignty and national security, arguing that unchecked Chinese influence would hollow out Canada's industries and destabilize its economic structure. What makes this more significant is the timing. Just days earlier, Canada finalized trade arrangements with China that included tariff reductions on Chinese electric vehicles and expanded agricultural access, moves that directly contradict Washington's broader strategy of economic containment. Even more telling, this marks a sharp reversal from Trump's own comments earlier in January, when he publicly said Canada should pursue trade deals with China if it benefited their economy. Now that tolerance appears gone. Canada's response has been defensive but firm. Prime Minister Mike Carney has leaned into a Buy Canadian strategy, emphasizing domestic investment and self-reliance, while acknowledging that external economic threats are growing. The result is clear. trade friction is back on the table, and supply chain stability is once again in question. And while international trade tensions are heating up, domestic political risk inside the United States is resurfacing at the same time. Government shutdown risk returns. The odds of another government shutdown by January 31st surged to 75% per Polymarket. Less than 3 months later, the government shutdown is back. According to prediction markets, the probability of another U.S. government shutdown has surged, and this time, the risk is immediate. The standoff centers on a spending package passed by the House on January 22nd, which now faces resistance in the Senate. Democrats, led by Senate Majority Leader Chuck Schumer, are demanding the removal of $64.4 billion in Department of Homeland Security funding, citing political fallout from a fatal January 24th shooting tied to ICE operations in a sanctuary city. Republicans argue that the move is pure obstructionism and are pushing forward parallel legislation, including enforcement-focused measures like the SAVE Act. With the bill requiring 60 Senate votes to pass, negotiations have stalled, and time is running out. Both sides are blaming each other, but markets see the same thing they've seen before, a familiar pattern of fiscal dysfunction returning at exactly the wrong moment. What this all means for crypto. When you step back and connect these threads, a clear macro picture starts to form. On one side, you have escalating trade tensions, renewed tariff threats, and rising geopolitical fragmentation, all of which historically increase currency risk, inflation uncertainty, and cross-border friction. On the other side, you have domestic instability in the United States, where budget battles and shutdown risks reinforce the perception that traditional governance is increasingly reactive rather than strategic. This is the environment where crypto has historically thrived, not because it replaces governments overnight, but because it offers neutral, programmable, and globally accessible financial infrastructure when trust in legacy systems starts to erode. Bitcoin benefits as a hedge against monetary and political uncertainty. Ethereum benefits as the settlement layer for a financial system that is actively being re-engineered. And the broader digital asset ecosystem benefits as institutions search for alternatives that are resilient to both geopolitical conflict and domestic dysfunction. What makes this moment different is that crypto is no longer fighting for legitimacy while these stresses emerge. It already has it. The institutions are in, the infrastructure is being built, and the macro environment is once again creating the conditions that accelerate adoption. If you want to understand where crypto is going next, you can't just watch charts. You have to watch policy, power, and pressure. If this analysis helped you see the bigger picture, make sure you're subscribed, leave a like, and share your thoughts in the comments. Thanks for watching, and I'll see you in the next one.